Well, hello everyone. Welcome to Payne's Education. This is our Thursday morning intermediate advanced class. My name is Gary Edmonds. I will be the host and instructor for this today. Good to see all of you on board this morning. And just a kind of a reminder, as you are bringing up your chat window, please make sure that you change it from host and panelists to everyone, so everyone gets to enjoy all of your wisdom and great comments as you chat those in. So let's glad to have you on board here. As this class, you know, we do rotate every other week through the instructors. So Rob and I have been teaching it this quarter, and so you know we'll be going over this. It's hard to believe that we're coming up on the end of August here really quick. We're more than halfway through. So good night. What's going on with there? So one thing that we will do before all of our classes and as we get started, we need to run through our disclosures just to make sure everybody is aware that the presentations and this presentation specifically is for educational and informational purposes only. All investments involve risk, and past performance of anything in the market does not guarantee future results. Unstoppable Prosperity and Charles Payne are not giving investment, tax, legal, or other professional advice. Unstoppable Prosperity retains all titles, interest, and intellectual property rights of the material provided and may not be used without express written consent. Nobody associated with Payne's Education or licensed, so we cannot and do not give recommendations to buy or sell anything. If you see something you like, please make sure you do your own research and analysis to see how it fits your investing strategies. The terms Unstoppable Prosperity, Payne's Education, Wall Street Strategies, and other marks and logos displayed on its websites or other communications may not be used without express written consent. Charles Payne's experiences are not typical. His results are not a guarantee of your success. Unstoppable Prosperity is not endorsed by or affiliated with Fox Business. Making Money with Charles Payne is the property of Fox News Network, LLC. All right, and folks, here's me. You veterans know who I am. You newer folks will get to know us instructors very, very well. So folks, remember that as we are going through the beginning intermediate class, it's taught on Wednesday mornings, and Thursday intermediate advanced class, which is this one. This is a little bit different than the regular daily Q&As, and so we're not going to be just answering questions that you're throwing out there about looking at any kind of particular stock or anything else along that line. We do have topics that we will get through and try to get the point across to help you get moving forward with your investing and trading with different ideas and different things along that line. So this is something that we are going to talk about today: trading to the downside. Okay, now I know, oh, Debbie, welcome. Since this is the first day in class, so glad to have you on board. Appreciate you taking time out of your day to join us. We appreciate all. So thank you very much, and I applaud your enthusiasm of getting some questions and typing some things in there. So, but that would be a perfect question for the Q&A, the stock Q&A on that one. Now, so trading to the downside. Yeah, and this is a great group. You will be welcomed with open arms here. So appreciate it. Now, our topic for today is going to be trading to the downside. Great class today to match the market conditions. Jim, you know what? I cross my fingers. Anytime, it's very hard to get a topic, especially come up with something a week or two in advance to try to talk about, and the market doesn't cooperate. Now, unfortunately, or maybe we should say fortunately, for this topic, the market is cooperating. Maybe unfortunately, it's not cooperating for our accounts, for positions we already have. But again, folks, remember, we are trying to kind of round you out and help you get a little bit more comfortable on just instead of just sitting there not doing anything, that if you wanted to, you can go ahead and try to take advantages of some things that you could have available for you if you so choose and desire. Now, again, a lot of times people will think about trading to the downside as a scary thing. I do know folks that are out there that refuse to trade to the downside. They just don't like it. They say, well, I'm betting against the company. Well, you're not betting against a company. In essence, you're trying to take advantage of a company that is that's struggling at that point in time. Now, I'm not saying that the company is destitute and going to be bankrupt or anything like that. No, it's just at that point in time the company's struggling a little bit, or the market's struggling a little bit. Okay, so we're going to talk about trading to the downside, and hopefully give you some ideas, or maybe introduce you to some things that you didn't know about and what you could do. So first and foremost, we'll talk about securities that you can trade. We will get into shorting a stock and some of the things that you might need to do or be aware of in order to be able to do that. Also, we will go over and talk about understanding the risks of it. Okay. So first and foremost, I'm going to ask you this, folks. When you think of the market, and hopefully you're thinking about the market every day, but when you think about the market and you think about how to make money, what's the most common idea or the most common way that you think of, and why you actually personally got into the market? What are some of these things? Okay, Gil says buy low and sell high. That's how you make money. Stock go up, capital appreciation, price increase. Absolutely. So why did you get into the market? Money, make money, price increase, right? So we have situations where the market will grow wealth. Okay, market will go up. And we have situations where the market will still go up, but maybe not at as high of a rate or as steep of an incline, and sometimes it can take off. But again, what are we looking for? Right? Who decided that I'm going to get into the market because this is what I'm expecting? It's going to rain money down on me. And Charles says it's the greatest wealth building machine. That's absolutely correct. Morgan says, I like being tortured. I'm sorry about that. Sometimes it feels that way, right? It is one of the greatest money wealth building machines out there. But again, right, are you getting in here because you are thinking, oh my goodness, it's a get rich quick type of a scenario situation? Unfortunately, there are too many folks out there, or even too many quote unquote people who are trying to get you involved in their process to trade in the market. They focus a lot more on the get rich quick type of a thing, right? You all remember those infomercials where they have the big beautiful home with the pool and all the expensive sports cars and all the fancy, everybody walking around the pool in their swimsuits, and this could be your life if you just follow me. I'll get you rich in just a couple of weeks. You'll be rolling in money. Okay. Now, sometimes you can get into a trade that will do this. It'll rain money on you. But it is going to be a process over time where as you build good, solid foundations for your trading and rules and things along that line, then it will be a wealth building machine for you, as long as you're following good, solid rules and things that are making sense for you and what you're trying to do. Okay, so let's stop making it rain. There. Sorry if you were just being mesmerized by falling money. Now, one of the things that we need to understand is the market has a bullish bias. It really does. And so this is why it's kind of one of those wealth building machines. It is because it does have a bullish bias. And why does the market have a bullish bias, folks? Well, it could be that everybody's optimistic about it. There's the optimism that if I put my money into it over time, then it will make money if I pick the right things and put my money into the correct companies and things like that. Well, yeah, there's that optimism. Now, there's also, it's because that's what you're supposed to do, right? Everybody knows we're supposed to put our money in the market. And there is a lot of new money coming into the market every week. I mean, so folks, think about this. How many of you ever worked at a job, and through the course of that job, every time that you got a paycheck, whether it was on a weekly or every other week or monthly, however you got paid, you were having money that was being taken out, not by the government, but by your retirement plan. And you were putting money into your retirement plan every single paycheck. Okay. Yes, exactly. So this is the new money coming in every single week. So folks, if your money is going to these mutual funds or these retirement accounts, that money has to go into whatever you have chosen, whatever you are putting your money into, those funds. Now, they might sit on that money a little bit, but generally speaking, there's rules and laws based off of the perspectives of those things that they have to invest, a certain percentage of that money into those securities. So therefore, this is why the market does have this bullish bias. Now, it doesn't mean that the market is going to go up every single day or every single week or every single month or heck, even every single year. Okay. So so just because there's new money coming in doesn't necessarily mean at that point in time, the markets will go up. But this is kind of the biggest reason that the market does have that bullish bias. So now, when we are getting into situations where the market isn't bullish, or what maybe where sectors or industry groups or individual stocks are not bullish, then we need to know how to take advantage of the move in the opposite direction if you want to. So when we are looking to trade bearishly, again, this is a little uncomfortable for some people. But I think, folks, once you start to get a little bit more feel for it and things that you can do, it can make it a little bit easier for you. So we will go over and talk about some things today. We'll talk about shorting a stock. We will also go over and talk about buying puts. Okay. And then we will also go over and talk about using inverse ETFs, exchange traded funds. So we'll spend some time on each one of these and help you get a little bit more comfortable, a little bit more familiar with it. Now, as we start off, let's talk about shorting a stock. Now, how many of you have ever shorted a stock before in your investing career? Jim says, you had some paper money. Okay, that works. I'm seeing a lot of no's. Okay. Well, there's a yes that pops in there, Michael. Good job. A few times, says Jack. All right, fantastic. Now, let me ask you this. For those of you who are saying no, why? It's the dark side, says George. Is it just because you don't know how to do it? Fear of the unknown? Okay. No clue how to? Okay, well, cool. So good. That's why we're kind of going over this today, right? Get to help you get a little bit better understanding of it to see how it fits your trading style. Okay, so let's talk about shorting a stock first and foremost. What is it? You are selling a stock that you currently do not own. Now, how many of you kind of think that's not legal? I mean, it's like, how do you short something that you don't, how do you sell something that you don't own? Right? It sounds wrong, says Patty. Yeah, you sell the stock that you currently have. Now, again, folks, it's not illegal. This happens all the time. You can actually sell a stock before you buy it. Okay, so how do we do this? First and foremost, you are going to borrow the shares that you're going to sell. Don't try this with your neighbor's car. Some people have done that, but anyway, so what happens? You want to short the stock. You inform your broker that you want to short a certain stock. So your broker will need to find the shares of stock to let you borrow or sell them first and foremost. So, brokers will generally have either in their own accounts or through accounts of clients that they have, will have shares that will be available for borrowing, so to speak. Now, so what happens is that that you put an order in to short a stock. They will go out and find the stock if it's available to be shorted, to be sold, and they will allow you to do it. So they're being nice in that situation, right? But this is something that's called sell to open. So you're selling a position that you do not have, and then when it shows up into your account, it will actually have a minus sign in front of the number of shares. Okay, and that indicates that it's a short position. Now, Steve, how do brokers have stocks in their account? Well, brokers, well, they have inventory of a lot of stocks. They do in their own in the company's firm's accounts. They have a lot. They do a lot of shares. And a lot of times they might just, if they get trades in there, they might just, take it out of their own account and things like that. But anyway, sell to open. You do not have the stock in your account. You sell it to open, and it shows up with a minus sign in your position. Now, if you're going to close that position out, then it will be buy to close. So you're still doing a buy order, and you're doing a sell order. Now, again, what is this going to look like, right? So if you have a stock, where did my cursor go? There's my cursor, right? If you have a stock that's doing this, okay, going down, and you want to try to take advantage of that downward trend or that downward movement, well, guess what? You could sell the stock up here. I'm just going to go right here and say sell to open. And I'm just going to make up a price here. Let's just say sold to open at $130. Stock goes down. Okay. Continues to go down, and then maybe at some point in time, maybe down here. Okay, let's just say down here at some point in time that you wanted to close your position out. Then you would buy to close, and let's just say that you bought to close at $70. Okay, so you can do this. This is legal. You still did what's called a round trip. Okay, you get this round trip, and a round trip is basically an order, a position that you have in your account that you have opened and closed. Now, if you just do a buy order and it fills and it's in your account, that's only half of the round trip. A round trip, and in the market you hear that term, it's where you open a position and close a position. Now, in this situation, when we're shorting the stock, we still have an open and we still have a close. We still have a buy and we still have a sell. We just did it in the opposite order. So in this situation, we are selling at the higher price first, and we're buying it back to cover or buying it back to close at the lower price. So in this situation, folks, we still bought low and sold high. Okay. We still bought low and sold high. We just did it backwards. Okay, now there isn't anything wrong. There isn't illegal. It's not nefarious or anything else along this. It's perfectly legal. Okay. Now, Greg asked, can retail investors get paid for loaning out their shares? No, they do not get paid for loaning out their shares. And I'll talk about that in just, well, I'll talk about it now. Okay. Anybody who has a margin account at their broker has basically have agreed to have the margin account. Now, margin account is basically where you can borrow money from your broker to do some trading. So when you open up a margin account, you basically, in the agreement, when you fill out the paperwork, have agreed to the broker to allow the shares that you have in your account could be used for somebody else to short sell. Dan, yes, this is buying and selling the stock right here. So we will get into the option portion in just a little bit. Okay. So shorting a stock, this is what this is. Now, so when you open up a margin account and you have a stock in there, you have agreed to allow the broker to use your shares if somebody wanted to short the stock. No, you're not losing the stock, Diane. You are not losing the stock. You're just, it's kind of like collateral for it. Nope, the value of the stock does not change for the loaner. You won't know, basically. You will never know. You won't see any change. You will never know if your shares are being used or not. Okay. So don't get hung up on that part of it. So here we go. That's kind of the process here of shorting a stock. So what are the pros? What are some of the advantages of it? You can make money when the price of the stock goes down. The bigger the drop, the more money you make. Right? The stock keeps going down, the more money you will make, and you can close it out at a lower price. You can buy it back for a lower price. You don't need to own the shares. In fact, you're shorting the shares, you're borrowing the shares. So you don't need to own the shares. Now, you could own the shares and still short that same stock, but you have to do a specific type of order. Because if you go in there and you own the shares and you put an order to quote unquote short the stock, which is selling, you'll just close your position out. There is a special order that you could do against shares that you have. It's called shorting the box, short against the box, where you're telling your broker you want to keep the shares, but you also want to short the same stock. But that's something that's even a little bit more complex, but we're not getting into that. Now, what are the cons? There's always pros and cons to everything you can do in the market. You need to have a margin account. Dan, you can close it out at any time. You are correct. Now, you need to have a margin account. Now, you cannot do this in a retirement account because you cannot have margin in a retirement account. So it will be a taxable account. And all you have to do is fill out the paperwork from your broker if you change your account from a cash account to a margin account, or just go ahead and open up a different account that's a margin account. But you need to apply through the broker to have that margin account. You are borrowing the stock. So remember, the broker isn't going to allow you to use the stock out of the kindness of their hearts. They're in it to make money. So if you are shorting the stock, if you are borrowing the stock, just like any other thing that you will borrow in the financial world or any place else, you will need to pay it back, and you will need to pay it back with interest. And depending on the interest rate, every broker will have their own rate that they will charge, and that can vary from account size as well. So you will be having to pay that back for as long as you are in that trade with interest. Pay the piper. You got that right, Diane. Now, the other con is the broker can close that position out without you asking them to if the value of your account drops too much that it puts your account in what they call a margin call. Now, there will be a couple different margin calls that you could be aware of. One is that the broker might have a specific threshold that in your account that you have to have as far as the value and as far as the amount of cash that is in the account or positions that is in the account, the value of the account, in order to allow you to keep that position open. And then there's another call where the market has set a limit on there. So there's a market call and there's a house call or the broker call. Now, they do this because they tell you that they don't want you to get in trouble. They want to protect you, but in reality, they're protecting themselves. And you just happen to be one of the beneficiaries of them protecting themselves. So if the value of your account drops too much, they can close that position out without even telling you. Now, they will actually they can do a couple different things. They can they'll send you some information. They'll send you an email. They'll maybe call you or do something and say, hey, your position is in a call. You need to do one or two things. You need to either get cash in the account or close a position out, close something else out, and to make it good. You need to have the account balance up to here. So just kind of keep that in mind. That's one of the cons. There's a lot of times people are surprised or get mad when the broker goes ahead and does this because the client or you or the person is not making good on the responsibilities to keep the account up at a certain balance. Okay. Now, market, you are correct. The margin account balance for Thinkorswim is 25,000. That's just to allow you to have a margin account. There are other rules then inside of that once you start to trade that will give you that you will have to maintain in that, as far as not just that your account has to be $25,000. There are other things now based off the value of the positions that can do that. Okay. Now, not all stocks can be shorted. So you might want to do something that's just falling off the face of the earth, but it may not be shorted. So what does this look like? Okay, so folks, I'm going to go ahead and bring up my Thinkorswim Paper Money platform. Now, the nice thing with the Thinkorswim Paper Money platform is you do have the two accounts. You have an IRA account and you have a margin account. Margin account will allow you to practice this particular strategy. Now, are there minimum share requirements on a trade? You would need to find out from your broker on if they're going to allow you to do in round lots, meaning 100 shares, or you can break that up into smaller shares. Okay. Now, I used to have in my margin account here a short position. Okay. I don't have it anymore. In fact, I closed it out a couple of weeks ago. So the position I had, let me go ahead and I'll go ROKU. No, wait a minute. Was it on Roku? I'm going to have to figure this one out. Just give me a sec. Let me do this. Pretty sure it was, but let me see. Yeah, it was Roku, ROKU. Okay, that's what I thought. Usually it pops up here, so maybe I have my trades turned off. All right, here, show trades. I'm going to put my show trades on here. All right, so there we go, right here. We can see I bought 300 shares of Roku, $97.71. You say, well, that's a buy. You bought that. So where's the share? Where's the sell? You didn't short this. It looks like you bought it. Okay. Well, I'm going to go back in time. I'm going to go back a little bit. You can still see it here, but I'm going to go back on a 3-year chart. All right. So right here, folks, I sold 300 shares of Roku. at $350. And what did this stock do after I sold Roku? Well, it just kept falling and falling and falling. Now it did get all the way down here to, $39, $40 or something along that line. That would have been fantastic if I sold out at that lowest point. I just kind of held on to it. I didn't do much, just kind of see what it did. And then it started to run back up and I sold it out. I mean, I bought it, I closed it out. I bought it back. Sell to open at $350. Buy to close, $97.71. So in that scenario, did I buy low and sell high? Steve, is there a time limit? Nope. As long as the account was able to support the trade for that long. This was actually a year and a half, almost 2 years. Yeah, I bought low. I bought at 97.71 and I sold at 350. I just did it backwards. So I made how much? Well, about $250, $260, $280, right? Per share. $280 per share. Now in the paper money, pretty easy thing to do. Now in a real account, could I have held it on this long? Yes, I could have, as long as my account value was still high enough. Now I'm not talking about the minimum amount to actually have a margin account, but the overall account balance was still high enough that the broker didn't require me to add any more money or sell something or close something out or even close this position out. Linda, that's what's going to be my next point. But Linda asked how much interest was paid. Well, the interest, yeah, I would have had to pay interest. Now it's accrued on a daily basis. So when did I get into this thing? I got into this on 10/13 of two. Well, was that? Let me zoom in a little bit closer. I got into it on 10/15 of 2021. Got out of it on August 1st of 23. So almost 2 years. So I would have had to pay interest on that entire time that I was holding this stock, or I was holding this short position in that account. Now, whatever that may have been, now in the paper money platform, they don't charge you interest. You don't have to worry about that. But in a real account, yeah, I would have been charged interest that on a daily basis, accrued daily until I close that out. Okay. So did I need to have a minimum of $105,000 in the account? Well, I would have had to have a lot of money, because that position in and of itself was $105,000 just based off of that. Steve, how do they determine interest rate? Is based off of the current overnight borrowing rate and the Fed funds rate. You can, but the broker will actually have their own rate that they will charge based off, because it has to be higher than what the Fed fund is and what their overnight rate is. So, Patty, on average, how much is interest? Well, again, interest has actually gone up over the last year and a half, hasn't it? Because interest rates have been going up, interest rates have been climbing. So over the last year, those rates have actually been going up. And again, as I mentioned a little bit earlier, the size of your account, the broker might give you a little bit better deal on the interest rate. So size of account can matter. So any questions on interest and what they might be charging, they will have it on their website, or better yet, you can just call them and ask. Can the rate change during the process, Diane? Absolutely. Absolutely. Morgan says mine's over 11%. Yep, there you go. And he says it used to be 2.5% a couple of years ago. Oh, by the way, you're not Diane? Okay, sorry. Just that's what the name comes up on your. Oh, it's Steve. You just logged in underneath Diane's name. Okay, sorry, Steve. All right. So how do we? I'll probably forget, Steve. So forgive me if I call you Diane again. I'll try to remember. So bottom line, if we're going to do a short, now one thing I will mention. Okay, remember how I said all stocks may not be marginal. You may not be able to short the stock. Now, one of the things with Thinkorswim that's very, very helpful for us, if we go to the trade tab, then you will see a little section up here where it says either ETB or HTB, easy to borrow or hard to borrow. Now, sometimes in the paper money account, it gets a little confused. But if it's an ETB, easy to borrow, that means you can short the stock. Hard to borrow would be something that they feel it's either a new security or a very low volume stock, and they're not going to do it just because the risk is too great in that situation. So other brokers will maybe have a different way of identifying stocks that you can short. So it's the Thinkorswim platform, that ETB. Okay. So what about a downtrending stock? So first and foremost, right, we need to look for a downtrending stock to short. So where do we find a downtrending stock? And I know everybody's going to say, well, look at my account. My whole account's filled with downtrending stocks, right? It always seems that way, right? Well, again, you can use FinViz. You can use your search criteria. Okay. Karen said SQ. SQ. Black. Is that a downtrending stock? Well, it certainly has fallen off the cliff over the last 2 weeks, 2.5 weeks. That's downtrending. Longer term sideways, John. You got that right. It is. So it might have some support that it'll might stop going down at that point in time. Who knows there, or maybe a little bit lower. Maybe if you try to take advantage of that. How about like maybe a stock ON? Is that starting to come down? On Semiconductor? Yeah, it is. Now, when we talk about entering into a bearish position, now let's go to the trade tab. Can we see right here? HTB, hard to borrow. And if you put your cursor on there, that says hard to borrow, HTB. So if you saw that in a real margin account, then you probably couldn't short the stock. Now, in the real account, this actually is an ETB, easy to borrow. It's just that sometimes in the paper money account, it doesn't quite show if it's hard to borrow, easy to borrow. In the real account, it's easy to borrow. Now, Steve, how about a very volatile stock? Well, you could. Now, depending on what you mean by volatile, it's something that just makes big moves, because sometimes people are mistaken in thinking that a downward move on the stock is volatile, and that's not correct. Volatility on a stock means the stock makes big moves up, and it can make big moves down. But remember this, if you are doing it on a more volatile stock, your broker will have a higher margin requirement on volatile stocks. Okay. A broker will have higher margin requirements to hold a short position on a volatile stock. Okay. Now, do I look at high volume of sellers for confirmation? Nope, I'm looking at trend. But you could look at that. Now, if this is so when we're looking for entry signals for downward trending stocks to short a stock, folks, we look for just the opposite of the bullish. We look for breakthrough support levels or bouncing down off resistance levels. So folks, on semiconductor, is this breaking down through a support level? It is, right? That's, in fact, yesterday or today, it's broken down through the support level, about 92.5. Now, somebody might say, well, is 91? I don't think 90, yeah, I mean, there might be, but I think the next support level is clear down here about 85, 86. All right. So it's actually broken down through the support level. So if we wanted to, yeah, it's broken through multiple, Jason, you're correct. So if we decided today was a good day to go ahead and short a stock, now, of course, you would go and look at news and look at other things, obviously. How would you do it? Go to the trade tab, click on the bid price. Now it'll come up with whatever number you have defaulted for your number of shares. I have mine set at 100. So it comes up, sell 100 shares at the current bid price of $90. Go do it at a limit, or since the market is open, we can change that to market. Does not matter. Now, if we sold this 100 shares at $90, what would be the amount of money involved in this transaction? $9,000. Yeah, $9,000. Now, if your account can support that, then by all means, you can do it. Now, I'm kind of curious. Now, let's just say you're doing it off of $5,000. So that would mean what? Do about 60 shares in that situation in your account. Yes, Jim, into your account, but you still have to have the more than that to cover it, to buy it back in case the price of the stock goes up instead of goes down. So if I do this, I'm going to change this to market really quick here. We're going to confirm and send this. Okay. So sell to open. Credit of $5,400. So I was a little bit off there. So instead of 60 shares, let's go 55 shares. That should put us under there. There we go. So credit of 44.96. I don't know. But that would still, now, are we doing it based off of how much money we would be willing to buy? Well, sure, because again, if this goes up, you will have to buy it back at a higher price, which means you'll be buying it back for more money. So you could do it this way, you could do however else you want. Now, I don't know if this is going to let us do it because of its yep, there we go. The stock is not available to borrow. Okay, that's what I was afraid of. Hard to borrow. Even though in a real account, it's easy to borrow. Okay. Even though a real account, it's easy to borrow. So one of the other things, A, B, and B, Airbnb. So John, cost of trading, including commission, rate just says it's buying stock. Yes. Oh, bummer. This looked a little bit different earlier today when I was looking at this. So Airbnb was actually going down today. Oh, that's another hard to borrow. Oh, what is this doing on me here? All right. But that's how you would just kind of short a stock. Diane, can you just change from stock to a number? You can when you're doing the trade. You certainly can. What about another? Downward trending stock. Well, so you're saying Meta, Microsoft. Is Microsoft really downtrending? Yeah, kind of at a support level. Meta. Now these are big companies. Is it downtrending? It could be. Maybe you're trying to take advantage of it. Yeah, Disney, right? DIS. That's downtrending. GSK. So see, there's a lot, right? GSK. Yeah, I don't know if I would put this so much as a downtrending stock as I would the other one. Can I wait for the price of the stock to go back down? Sure. Sure. And you want to be cautious of entering into position before an earnings announcement, just like with buying a position. Can easy to borrow, hard to borrow be displayed in a watch list on Thinkorswim? Might be. I don't know. I haven't looked at it in a while. You can go ahead and pull, the little gear and pull that up. Not going to get into this. We're kind of going off into the weeds a little bit here. We got other things that we need to talk about and get moving forward. So folks, find your stock. How about CVS? That downtrending? It is basically getting clobbered today. Right? It was downtrending, tried to rally, and is getting clobbered today. CVS, a big company? Sure. Would it be hard to borrow? Easy to borrow? Easy to borrow. So if we wanted to do this, let's pop this up here. That's going to be about $6,600. I'm just going to do 100 shares on here. I'm going to confirm. This is what it would look like. Sell 100 shares CVS. Actually, let me do this. Let me do this at market instead. Okay. Sell 100 shares CVS at the market to open. This is what's coming into our account up front, but again, kind of with some stipulations. Buying power effect. Now, do you see something here about the buying power effect? Well, it's negative, but exactly it's half of the credit. So it's called this is what the market, it's called the Reg T. This is what the market is. It's a 50% margin to start off with, that you have to have either cash or margin available in the account to go ahead and do this. Now, if it's a volatile stock, after the position's in the account, the broker will probably increase the amount of it. So you might see a stock that might have higher than a 50% margin requirement. It might be, 60, 70, 80% margin requirement. That means you'll just have to have more money in the account after you get into the position to hold it. Now, the account value has to be higher in order to sustain it. So that's what that is. That's the buying power effect right off the bat. That's what the market, the SEC, says you need to have. Now, do you have to do 100 shares? No, okay, let's do this. Now, again, you would have to find out from your broker personally if you can do something less than a round lot. So let me just do 70 shares. That's a little less. Let me go 75. Whoops. Let's do 75 here. Okay. And we actually might get away with 76. Let's do 76. All right. So what are we doing? Selling 76 shares of CVS market to open. Right now, let me do this. I'm going to do some more analysis. Is at the bottom. Whoops, wrong one. It's at the bottom. Well, is it breaking through a support level? It is breaking through a support level. And is it doing it with a high volume? Not that that's necessary for it to break through support, but yeah, it's getting clobbered. High volume, 20 million shares already today. The market's only been open for less than 2 hours. So it's doing it with high volume. We can go back further if you want, but guess what? Just because the stock is at a 52-week low doesn't mean that it can't go any lower. Just because the stock's at an all-time low doesn't mean it can't go any lower. Now, the only time a stock can't go lower is if it's zero. Now, one thing that you probably want to do, folks, as you are looking for stocks to play bearishly, short or play a put, what we'll talk about in just a minute, you need to make sure that there's room for it to go down. You don't want to short a stock that's trading at $10, $15. There's no room for it to go down. So have a dollar amount of a stock that you don't want it to be less than. It might be, $25, $30, $50, whatever it might be, or higher to give the room to go down. Okay, so let's go back to our trade. Let's send this off, confirm and send. I'm going to actually put it in here. Shorted for intermediate advanced class on trading to the downside on today's day. What is today's date? 8/17/23. All right, then we'll go ahead and send that off. So we sold 76 shares, CVS at the market. Go back to our monitor tab. There's our trade. Whoop, let me go back to the activities position. There's our trade right there. And so we can see it shows up minus 76 shares. And we have our note right there. Okay. So we already just had this earnings announcement. We didn't need to worry about it for another 2.5 months. And we're looking for this to continue to move down. All right. That process, folks, does that help out? Does that make sense? Shorting a stock, getting you a little bit better feel for it, what you're looking for, why you're looking for it, when your entries would be. Now, you could also look for a target and say, well, I think the stock is going to go down to this level by, in this amount of time, and put an order to buy it back. So let's just say, now, okay, let me do this. Let me go back and I'll go out on a 3-year chart. Right there. And let's just say, oh, you know what? I'm going to target $60 because it looks like it was a resistance back here. So I'm going to target $60 on it. Okay, so we can have maybe a $5 profit on there, a little less than 10%. So, so what do? We can put an order to close it out. And how do we do that? Well, just like any other order that we will close out, we'll right click on it, create closing order. Now you see it says buy right there. So we are now, if we do this as a buy limit and we change this to $60, and we want to also change it to a GTC. Now let's think about this, folks, because this can get a little confusing. If we do a buy limit at $60 and we send this through, will this order execute immediately? Okay, no, it won't. Why? Because this buy order means that we're telling the market, do not buy the stock unless it's at $60 or lower. So sometimes people get confused in this situation. They always think of a stop. If the price of the stock is lower, I'm putting this place in at lower, I have to use a stop. Okay, now remember, a stop, think about a stop as stopping your losses. So when you use a stop, it would be at a price higher. A buy stop would be higher than the current price of the stock. Now we could do that, okay? We could do that. How can we do that? I'm just going to change this to an OCO order, and I'm going to click on this. Oops, I'm going to click on this and create opposite order. So now I have a buy and I have a sell with an OCO. So I did that kind of fast. I'm sorry. I clicked on here, the advanced order. It was on single. Then I went to OCO, just the OCO. And then when I got that OCO up, I went on the order that I had, did a right click and create opposite order. Now I have two on here. So the first order, $60, is our target. Meaning if it goes down to $60, we make a profit. The second order, we will now use as our stop. So I change it to stop, GTC. Then what we would do is we'd come in here. Let me go back to a shorter time period here. Now we have to make a determination. When do we want to get out? Well, where do we see resistance? Resistance, I would say 60, well, I'm just going to round say $67. $67. Now, we're not putting it at $67. We're going to put a 1 to 3% above it, because this is generally going to be a shorter term type of a trade. We were going to protect ourselves. So what would be 1% above $67? Well, let's go 67 times 1.01. Ooh, 67. Oh, Jim, you're correct. Let's go back here. It's a buy order, not a sell order. I clicked on just habit. I clicked on create opposite order. Habit for me. So you right click on it, it's actually create duplicate order, not opposite order, duplicate order. Good catch, Jim. So they're both closing out. They're both buy to close. So 76 shares, buy to close, buy to close. Now I'm going to change this to 67. GTC on both of them. And let's now see what this looks like. Hopefully I would have caught it when we went through here and read it. but glad we caught it beforehand. So we're going to buy 76 shares of CVS at $60 to close, OCO to close. Now that $60 is our profit. Or if it doesn't go down, then we will buy 76 shares of CVS at a buy stop of 67.67 GTC OCO to close. So that's our order. Now we put our stop in case it goes up 1% below above resistance, and we put our target in if it drops to $60. I'm going to send that off. No dinghies, no rejected trades. Yeah, there we go. Now we have CVS. We protected ourselves to the upside in case it goes up instead of goes down. And if we click on that, then we see there are our 2 working orders. So that's how you can put in and I'll come up here, working orders to close, buy to close. Chart, please, Sam. What do you mean by chart? You want to look at the chart again? Okay, what about the chart? What did you want to see on the chart? Want to see the stop? Right there. There's the stop. There's the limit. Loss, profit. All righty. We need to get moving forward. We got a lot of things to talk about. But wanted to show, because, you know, if folks, if you wanted to do this and start to short some stocks, again, need to have the margin account. Need to have an account big enough for your broker to start with to approve you for the margin account. And then just kind of the process and the things you're looking for. Okay, now again, you might not be 100%. I understand that completely. It's a process. That's why we record. You can go back and watch and get a little bit more comfortable with it. But let's talk about now buying a put. Now, this is something that can be even more confusing for people. So, what is a put? It's a contract. It's an option contract for a security, underlying security that's designed to make money when the security price falls. You know, it's just kind of like some big old book mumbo jumbo. It allows you to make money and the price of stock goes down. Now, the put gives you the right to sell the stock at a higher price than it's currently trading for. Now, how many of you here, folks, I know there are many of you who have both the stock and the option education, and I know there are many of you who just have the stock education. For those of you who just have the stock education and not the option education, because we talk about this, you know, all the time in the option education. But if you don't have the option education, you can get a little bit more information on buying a put and help you get more comfortable with it. So there is a stock workshop that's called Basic Option Workshop. It's one of the ones that we have on the website that basically is a sticky. It won't be taken off until maybe we do another one and replace it. So I'm on the Payne's Education website. I go to quick links. If we go to Stock Investing Workshop, and there we go. If we scroll down into the previous specialty workshops, Rob did a great one on dividends, and I did one beginning of last year, Introduction to Options. You can come in here and get a little bit better feel for options in general, but more specifically, go to the place about trading puts to help you get more comfortable with what we're going to talk about here. Okay, so let's talk about buying puts, folks. Pros for buying puts. Now, let me ask you this. How many of you here, first and foremost, do not have the option education? Okay, do not have it. So again, I'm seeing a lot of me's. And as I said, I know there many of you do and many of you do not. Okay. All right. So that workshop will be very helpful for you. Dan says he's done the covered call. All right. Now, so pros, you can make money when the price of the stock goes down, just like with shorting the stock. So now that you have kind of the basic understanding of shorting the stock, you kind of have now the foundation for buying a put. The bigger the drop, the more money you make. Hey, this is exactly kind of word for word that we saw on shorting the stock. You don't need to own the shares. Oh my goodness, again, word for word. You do not need to own the shares to buy a put. But you do not need a margin account either to buy a put. So this is one of the pros of buying or trading options over shorting a stock. You do not need to have a margin account. You do not pay interest on buying a put as you would shorting the stock. And the cost to trade the option is less than trading the stock. Just kind of what Gary just said. Gary says, I like puts more than shorting. You need less money. Yes, it costs less to buy a put and trade. Options in general cost less than it does to trade the actual shares of the stock itself. Scott, you can do it in a retirement account. Now, the cons. You do need to be approved to trade options. Now, there are different levels of option trading. Some brokers might have levels 1 through 4. Other brokers might have levels 1 through 5. But you do need to have the appropriate level to trade options to do buying options contracts. Okay, so you may or may not be approved to begin with, but that's where practicing in the paper money account and things along that line count as experience to your broker. I'll just put that out, throw that out there to you. Okay, you don't have to tell them it's paper money account that you got your practice in, you got your experience in. They just ask if you have experience. Okay, so you have to be approved to trade options and the appropriate level. You also could lose 100% of what you paid. Broker's not going to jump in and stop you from losing in this one. Not all stocks trade options. Non-liquid options can make it harder to be profitable, make money in this type of a trade. And if you want to sell, there may not be someone who wants to buy your option from you. And Dan, there is a limited time. Yes, indeed. So let's kind of go back here. Now, the cool thing about trading an option over trading the stock. Well, what was that stock that we looked at earlier? ON. It does not matter if it's hard to borrow. We can still trade options if we're approved to trade options in our account to trade a stock that's hard to borrow. Now, in real life, in the real account, it's not hard to borrow, but this is a great example. I couldn't short the stock. You find a stock that you couldn't short because it's hard to borrow. Well, if they trade options, you could do an option trade on it. Okay, so let's go back to the chart. Again, our entry signals, bearish trades, breaking through support or bouncing down off resistance. We already made a determination that this is breaking down through support, correct? Debbie, do you need to sign up for the options class in order to get more education on puts? Yes, and calls and covered calls and debit spreads and things like that. So we do go over different strategies in there as well. It's a great course. It's a great course. Of course, I might be a little biased. Define with support. There are several. Well, Yeah, you are 100% correct. Well, there was a support there that it broke down through, but we don't care about that because the price of stock's down here. Okay, there's a support level right here that broke through. We don't care because the price of stock's down here. There's a support level that it just broke through. That one is a little bit low. I'm gonna move that one up a little bit higher, but right there, that's the one that just broke through. Option classes are great, says Rick. Michael says great instructors. Well, thank you. So it just broke through this support level. Okay. So let's now go to the trade tab. So this is where it gets maybe a little more confusing, because there's a lot of choices you can make. And now getting into the option, if you make the wrong choice on the option, it's just not making the wrong choice on the stock. You can also make a wrong choice on the option and not have the trade work out for you. So there's a lot of moving parts, but I'm just going to give you a little bit of information here for you. You can go to that workshop and get a little bit more. I'm just going to open up one of these. I clicked on these options. Now the one I clicked on right here means that an option contract has a shelf life. It expires, it disappears. It doesn't go on forever and ever and ever like a stock. So this information here, this is showing us when the option contracts expire. So the first number is the day. The second is the month. And then the third, or that number right there, 23, is the year. So I open up the option contracts that will expire on Friday, October 20th of 2023. Now, this number in parentheses states how many days are left that you can trade the option contract. That's 64 days from today until October 20th. The thing in parentheses, I mean, not parentheses, that 100 next to the parentheses, that's how many shares the option contract covers. So 100 shares. An option contract will cover 100 shares of stock. So basically, if you buy an option contract, it's like you're buying or selling 100 shares of stock. Debbie says, I've only been in the stock class for 2 months, not so sure if I should learn more about the stock market first and then do options. All remarks are welcome. I did purchase the option class. I'm just not sure if I'm ready for it with only a few months in stocks. You know what? That's great, Debbie. I would say if you still have questions about the stock side of it, then I would hold off. If you feel like you're getting more comfortable with the stock side and feel like you can do what you're trying to do, then I would definitely then go into the stock on the option side. Okay. Now, so October 20th of 2023, 64 days out, controlling 100 shares. Now, on the right-hand side is where the puts are. And this is pretty common with most brokers. Puts on the right, calls on the left. These are what are called the strike prices right here. This is what you are agreeing to either buy or sell the stock for. With calls, this means that you are agreeing that you could buy the stock at the strike price, or if you're buying a put, you're agreeing that you can sell the stock at the strike price. So since we're selling, we're going to be on the right-hand side. We want to sell the stock, but what we will do is we will buy a put. So this information can't look a little confusing, but it's just like the stock. It has a bid and the ask, what you can buy the option for and what you can sell the option for. Also, mine has the last price that it traded. Also gives us the net, how much it's up or down for the day from the day before. Now, there are some other things, the Greeks and things like that, but it also gives us what's called the open interest in the volume I have. This tells you how many contracts are out there that are currently trading, and the volume tells you how many of those contracts have been traded today. So if I we expect the stock is still going to go down, on is still going to go down, then what we want to do is pick a price that we would want to sell the stock for. Now, the price of the stock is at $90. Now, would we want to pick a strike price and say, I want to sell the stock for $70 if the stock is selling for $90? Probably not. The only time you would do that is if you think the stock is really going to drop and get lower than $70, and quite a bit lower than $70. All right. So maybe what we want to do is sell something that is higher than the current price of the stock, because now we have a little bit of cushion built in. Now, I'm going to just do this. I'm going to just say 95 right here. So let's just say we wanted to buy the $95 put. Now, this gives us the right, since we're buying it, to sell the stock at $95. Okay. If we buy this option contract, so there's two sides to an option contract, just like there's two sides to any kind of contract you enter into, whether you're buying a car, you're buying a home, you're buying, soup at the store. Right? There's a contract. There's the buyer and there's the seller. The buyer has the right. The seller has the obligation. So when you buy the option contract, you are buying the right to sell the stock at $95. The person who sold you the contract is obligated to sell you the stock at $95. So Dan, are you betting the stock will go up in price? Well, let's ask this question. So remember, let's answer this. If we buy the stock, or if we buy the put, which gives us the right to sell the stock at $95, do we want the price of the stock to go up? Do we want the price of the stock to go up to $100? Because now we have the right to sell it at $95. Why would we want to sell it at $95 if the stock's at $100? Does us no good. So we want the stock to go down. Now, we don't want to be evil and say we want the company to crash, but that would be better for us. But, we want the price of stock to go down. We don't care if the stock goes down to $80 or $70 or $50 or $30. We have the right to sell that stock at $95. Now, a lot of times people go, well, if I buy that option contract, why don't I just immediately sell the stock at $95? And because I can sell it for $95 and then I can go and buy it for $90. That's a profit. Well, it is on the stock. But remember, just like anything else you do in the market, you are paying to get into the trade. So in this situation, you would be buying this put for $8.30 per share. Now remember, an option contract generally will cover 100 shares of stock. So this is a price per share, $8.30 per share times 100 shares. So that means that you would be spending $830 to have the right to sell the stock at $95. Now, folks, if you just went out right now and bought the stock at the current price, 100 shares, at the current price of $90.33, how much would you be spending? $9,033 for the stock, whereas you're controlling 100 shares of stock for $830. Yeah, now you can see kind of that benefit of an option is more cost efficient to control a larger amount. Okay. Now, if the price of the stock drops from $90, let's just say the price of the stock drops to $60. Okay, goes down to $60. You have the right now to still sell the stock before the 20th of October for $95. Now, if you wanted to do that, then you would actually have to go out and buy the stock at $60. You don't need to own the stock to buy option contracts. You're just buying a right to do something with the stock. Now, if you decide to actually do something with the stock, then you would have to go out and buy the stock. But let's just say we did. We went out, we bought the stock for $60, and then we get to turn around and sell it for $95, even though the stock is trading at $60. We then have a profit of $35 per share. And that's just if we did the stock, we exercised the option contracts, told our broker, I want to exercise my option, sell the stock at $95, buy the stock at the current price of $60, boom. Now, you would have to subtract the $8.30 that you paid for the option contract to get you your net profit, because you have to subtract the cost there. And there you go. Or if you don't want to deal with the stock, let's just say I don't want to go out there and buy the stock and then sell the stock at 95. Some of you are now starting to say this. You can then just sell the put back for the current value of the put, not the strike price, but the current value of the put. Now, if the price of the stock does go down to $60, well, guess what? This put is not going to be worth $8.30 anymore. If the price of the stock drops to $60, folks, at a minimum, the value of that put, meaning that you would be able to sell that put for would at minimum be worth $35. That you can sell it for, minimum. It could be worth more if the stock price dropped to $60. So if you bought the option contract for $88.30 and sold it for $35, then there's your profit. You don't have to deal with the stock. You can just buy and sell the option contract. And the majority of the people who actually trade option contracts do this instead. They just buy and sell the option contracts and don't worry about owning the stock or doing anything with the stock. They're just trying to take advantage of the movement of the stock. And Sam says, leverage, baby. Yes, sir. That's leverage. And so the more the stock drops, the more money you're making with the put. Where did the $35 come from? Well, if the stock was trading at $60, the strike price, I got a lot of things drawn on here. I'm sorry, let me erase all that. So if the price of the stock dropped to $60, okay, you still have the right to sell the stock at $95. What's the difference between that? Is $35. So that's why the option contract would be worth at least $35. More than likely, it would be worth more, but it would be the minimum of 30. Now that's what's called intrinsic value on an option contract. That's the real value. Now it could be worth more, but that's the minimum it would be worth if the price of the stock was $35 lower than the strike price that you had. Dan, wouldn't you make more money if you purchase a stock at 60 and then sell it at 90? money wise, yes. But percent wise, no. Percent wise, no. But actual dollars, yes. So that's also, it's just, again, if you have money in the account to be able to go and buy that position at the current price, then you can do that. Well, what's cool about this, I don't need to have $6,000 in my account to buy this put. I can have $10,000 in my account, $5,000 in my account, and still buy this put and not have to worry about the stock and just make money off of buying and selling the option contract itself. So however you folks want to do it, you can do that. But I'm going to do this. I don't know, the price change. So how do we do this? I'm going to click on this, boom. Now, when you do trade puts though, folks, again, the dollar amount, when you trade it, probably will be less money from your account that you're using, right? So if you say, I'm going to spend $5,000 on a stock, yeah, you probably won't spend $5,000 on an option. So because they are more risky, and with more risky trades, you probably want to have less money allotted to more risky trades. It's because kind of like that speculation trading. Trading options is really speculative. And so what do I always say with speculation trades, folks? Use a smaller portion of your account. So you might say, if I use $5,000 on a stock, maybe I might use $2,000 to trade options with. Okay. Or, you know, $2,500, maybe half, $2,500. So in this situation right now, if one option contract is going to cost us $8.10 per share, or $800.10, we could probably do 3 contracts. So I'm going to change it to 3. What this is showing us here now, I clicked on the ask price. I did that a little quickly, and I apologize. I clicked on the ask price and it brought this up. So we're buying, and I changed it to 3. ON, here's the expiration date, October 20th of 2023. This is the strike price. This is what tells us, was it a call or a put? We're buying the put, the current price at the limit, and then for today. Okay. Now just change a little bit. Oh, it went down. Well, probably not going to fill, but let's just see what we got going on here. So this is what it'll look like. We're buying 3 contracts of ON, controlling 100 shares of stock, October 20th, 23, 95 strike put at an $8.05 limit to open. Now break even and all this kind of stuff, I wouldn't worry about. But this is what we're paying. Little less than 2,500, a little less than, you know, half of what we would do on the stock. You come up with whatever number you're going to use. All looks good. I'm going to send that off, and it's there we go. We got filled. Didn't take long. Got filled. So I go back, and here is ON right here. Now, to see exactly what it is, because we don't have a lot of information, if I open it up, now we can see that information. There we go. There's the put. Okay. And gives us, you know, the values and so on and so forth. And you would track it exactly like you would a stock. The profit loss open, profit loss days, whatever you're looking at, it's exactly like the stock. Now, I didn't put a note on this. I'm going to put a note on here really quick because I wanted to get that order in before. Trade for intermediate, advanced class, trading to the downside on 8. What's today? Did I say 17/23? Okay, and click on save. So what we're doing now is we're watching the stock, waiting for it to continue to go down. Now, you can do the same thing. Not going to get into the, the depths and details and things like this, but maybe, folks, you wanted to protect yourself. Now, we spent $8 for the option contract. Maybe you are only willing to lose half of that. Maybe you're only willing to lose $4. Because we always want to protect ourselves. So if the price of the stock goes up instead of goes down, then we're losing money. The value of the option will get less and less. We want the stock to go down, so the value of the option will get more and more. So we paid $8.05. Right now, it's at $8.05. So we haven't made any money. This is changing all throughout the day. I take my drawing tools off. If the price of the stock goes up, the current price of the option, the put, will go down. If the price of stock goes down, the current price of the put will go up. And that's how you'll track that. But let's just say we wanted to protect ourselves. We don't want to lose more than 50%. So how do we do that? Well, right off the bat, I'm going to do a right click, create closing order, sell. Now, it's just not a limit. I'm going to do a stop. Then we put in, well, I don't want to lose more than $4. Change this to a GTC. So now what happens? If the value of the put, now this isn't the price of the stock, but if the value of the put itself drops from $8, what we paid for it, down to $4, then get us out. We don't want to lose more than that. We're willing to lose 50%. You can put whatever price that you're willing to lose. 50%, 30%, 60%, whatever it might be. I wouldn't do it. I wouldn't get closer than 50% though. If you are going to do it, I would have it at least 50%. You want to give it some wiggle room. Prices of options can change drastically without much of a change in the price of the stock. Okay, so we confirm this. Here we go. We're selling our 3 contracts of October 23rd, October 20th, 2023, 95 put at the stop of $4 GTC. Send that off. Now we go back to the monitor tab. There's our sell order to protect us in case the stock goes up instead of goes down. Now, if you could put a profit target on there as well, but just kind of showing you some basics there. All right. One more thing to talk about. I know we're like an hour and a half in, folks. Are you still good to go? Are you getting pooped out? Let's go. One more thing to talk about. Inverse ETFs. How many of you have ever heard of inverse ETFs before? Okay, seeing a lot of yeses, some no, now I'm getting a lot of no's coming in. Okay, good. So what is an inverse ETF? Now we all know what ETFs are, right? An exchange traded fund. It's a basket of stocks that will basically follow or track either industry groups, sectors, markets, countries. So it's a basket of stocks. So it's kind of like a mutual fund that trades like a stock. That's what an ETF is. Now, an inverse ETF, folks, it's basically designed to move in the opposite direction of the stock or what it's tracking. And as I said, it could either be an industry group that it's tracking, a sector, the market, a country. It could also track bonds, commodities, currency. So there's a lot of things that it can track. So you're just not limited just to something. Now, it doesn't track an individual stock. We already went over how to trade a stock to the downside. It's tracking a basket of stocks now. So what are the pros of an ETF, inverse ETF? You do not need additional account permissions. You don't need to have a margin account. You don't need to have an option account permission. You can do it in any account that you can trade stock in. It's a way to hedge your account or an individual position. You can trade these even if you don't own the underlying stock. You trade them with the exact same rules you already have to trade a stock. It's strictly a technical analysis or a news event type of a trade. There's no fundamentals on there because fundamentals are based off of individual companies' numbers and results. ETFs don't have it because they're a conglomerate of stocks. Now, also, for those of you who still kind of struggle to look at bearish trends and understand entries and exits and things like that, maybe one of the biggest pros of an inverse ETF, it allows you to trade bullishly. So it allows you to trade bullishly. So what do I mean by this? If you have an ETF or the market, let's just say that the market is going down like this. Let's just say this is the S&P 500. Okay, S&P going down. The inverse ETF would be doing this. Okay, so I'm just going to go inverse. It kind of looks like a IW or something like that. So it allows you to trade bullishly because the inverse ETF is going up while what it's tracking is going down. So you'll still look for your bounces off supports or your breakthrough resistance levels for your entries. So see, you already understand that, you know that. So it's easy to look at the chart and get a good feel for it. Now, what are the cons? Many have very low volume. Just like with a stock, you probably want to avoid ETFs that are illiquid. I mean, there are ETFs out there that only trade a few thousand shares or a couple 10,000s of shares a day. You want to make sure that you have very liquid ETFs also. Many can be leveraged. So there are ETFs and inverse ETFs that do exactly what the stock is doing, move for move, percent per percent. There are ETFs out there that are double leveraged and triple leveraged, meaning they will move 2 or 3 times more than what the underlying moves. So you can have more leverage, but again, that does increase risk in case it goes down. Many will go through reverse splits on the inverse ETFs. So basically, if you hold an ETF and it's getting close to zero, because if the stock is going up and you're holding and the ETF is going down, they could reverse split, meaning that they're trying to get the price of the stock back up so it doesn't go down to zero. You can't go below zero. So they will do inverse splits and take shares away from you anytime. Any stock that does that will do that. Now, different inverse ETFs. Now, first and foremost, I've got the security, which would be kind of like the what it's being tracked, and then I have a name of the short, which is just the regular, ultra short, which is leveraged 2 times, and an ultra pro short, which is leveraged 3 times. So the security, diamonds, DIA. Okay, that's the ETF that tracks the Dow Jones. Now if you wanted to trade just the ETF, you buy the DIA. The short ETF is the dog. That moves exactly opposite at the same rate, at the same pace. Okay. The ultra short is the DXD, and the ultra pro short is SDOW. So what does this look like? I'm going to pull this up. We'll go and bring up the DIA. This is the ETF that tracks the Dow. Okay, DIA trading at $347.53. very liquid, right? Average volume 3.3 million. If we wanted to trade the inverse ETF, we'll pull up the DOG. DOG. Okay, not quite as liquid, but still, we're about averaging about 700,000 shares a day. Now, I'm going to do this. Pull up the DIA. So now we can see every single time the Dow went down, the DOG went up. And every single time, every single time the Dow went up, the DOG went down. Inverse relationship. If we wanted to get more leverage, pull up the DXD. Now, let me do this really quick. Let me get back here. Sometimes you'll see the words. Sometimes it's abbreviated. UL means ultra. So if I go back to my slide here, ultra short, okay, DXD. It's kind of hidden there. So you have to kind of figure that one out. That's ultra Dow. So basically this is a double leveraged ETF, but it's working exactly the same way. It's moving up when the Dow's moving down. It's moving down when the Dow is moving up, but it's just doing it at a 2 times leverage. Then, yep, it's even fewer shares, Linda, right? 390,000. Okay, and then if we wanted to get triple, then we can do SDOW. Okay, Ultra Pro Short. And that's what I said the name of it was, Ultra Pro Short. Now this one's a little bit more popular. Look at how many people. People love the leverage here for some reason. 6.1 million. It's trading more than what the actual DIA, the diamonds, are trading for. But this moves at a 3 times the rate. So if the Dow goes down, the DIA goes down, this will be moving, SW Dow will be moving up at 3 times the rate. And if the Dow goes up, this will be dropping at 3 times the rate. Okay. So nothing wrong with trading leverage. You would still trade them and treat them the exact same way. Technically, look for levels of support resistance, enters on your breaks, on your bounces, exit when you have your exit signals. So let's go back to some of the other ones really quick. Now, usually the spiders are the ones that most people will trade. Are inverses optionable? Yes, Panda, most of them are. Okay, so SPY, the SPY, the S&P 500, short is the SH, the ultra short SDS, and the ultra pro, or the 3 times leverage, is SPX. Then you have the Qs, QQQ, tracking the NASDAQ. PSQ is the short, the QUID, QID is the ultra short, and the SQQQ is the ultra pro. And I'm just going to do this, put this up here really quick. And so these are some of the things. Now what else do I have here? IWM, that's the Russell. Okay, then you can actually have the tech. You know, like I said, sectors. You can find things that have sectors. TLT is basically looking at the bonds, and then FXI, that's actually China. Okay, somebody said something about China. Steve, I said good time for a China RVR inverse ETF, right? So FXI, let's take a peek at that one really quick. FXI. So China large cap. Yeah, that one again it's coming down, right? But it's been trading sideways for the most part. A lot of shares, 3.2 million shares on average. But if we wanted to trade one of the other ones, let's do the Yang. And I guess that's opposite of the Yin, Yin and Yang. But let's do Yang. YANG. Triple leveraged. Almost 6 million shares. Inverse ETFs. Now, you might ask yourself, well, how do I know which ones? In fact, one of the things you could do is you can look at the sectors too, right? You just bring up a list of your sector ETFs. These are the 11 sector ETFs right here, and you can just kind of go through your list and see which ones might be heading down, and then find the ETF that matches or corresponds with it. Certainly looks like there's some opportunities for some shorter term downward moves on here. Now, a lot of times people, I don't know how to find these. How do I find these? Again, this list right here, it only talks about the markets. And I showed you the bonds, and I showed you like China. But you can, folks, go out and do a Google search and look for ETFs. I brought up one. This is kind of one of the more popular ones. It's ETFDB. So it's the ETFdatabase.com. And now this isn't comprehensive by all means. It does give us lists of these ETFs. And also, again, inverse ETFs, short ETFs. And it also gives us an idea, is it a leveraged one? So if it's more than a 1, it's leveraged. You'll have a 2, they have a 3. If it's 1, then it just means that it's moving exactly the same. Okay. On there. So you can scroll down here and take a look at it. I mean, they have it for like dust. Right here, I saw that one, dust. It's for gold miners, the second industry group, gold miners. It does go for 3 pages, but again, I went just to page 3. It's not an inclusive list, but it just gives you an idea, gives you a start. You can go back and start pulling these up and taking a look at it. If there's an area of the market that you wanted to do, or a sector or an industry group or a country, then you can do that. But the internet search is a good place to find some lists of what it is that you are going to be looking at. Now, again, one of the things I like with this is also, remember what I talked about, average volume? Can we see here? Oh, that's only 7,500, 7,600 shares of average volume. Probably wouldn't want to trade that. And all these right now that we're looking at kind of goes along that line where they're a little bit on the light side, right? But if we go back to the first page here, there we go. Average volume, right? There you go, the SQQQ. That's the Ultra Pro short, the triple leverage of the NASDAQ, the QQQ, 122 million shares of average volume. And then absolutely, anytime any website has like these little arrows on here, it means that you can sort. So you can click on there, sort it once from the most to the least, and get a good idea there. But now again, that's something for just kind of a reference. You can go and just do an internet search and find. Now this isn't a comprehensive list, but again, it's a pretty good list. If you wanted to, then you can go back here and take a look at it. Now one of them, SPY. No, actually, I'm going to do this. I'm going to go to the oh my heck, my mind just went IWM. IWM. Okay, Russell 2000 kind of broke down out of its channel, right? If we let me do this. This is what the rut looks like, the regular rut. Here we go. Okay, kind of broke down through its channel, so it might be heading down. Okay, might be heading down. So what are some ETFs? Let me go back here that might track the IWM inversely. We have the RWM, TWM, SRTY. Okay, so let's take a peek at these. Let's go RWM. So that one is uptrending. Trades average volume 1.3 million shares. Does this look again, let's not even think about what we saw on the IWM or on the Russell. Does this look like it's broken through some levels of resistance? Yeah, absolutely, right? So can you apply your bullish rules now? If you feel more comfortable trading bullishly, can you apply your bullish rules now to something that in reality you're actually taking advantage of a move down on the underlying security? Yeah. Okay, so that's the one that's moving, exactly the same percentage wise. Maybe we want to get a little bit more leverage. So this is the double ETF, ultra short, TWM. Okay, same thing. Is it breaking through those same levels? Well, of course it's breaking through those levels we identified earlier because it's doing the same thing. It's just doing it at a rate of 2 times. Does it trade enough shares? Yeah. 1.7. Plenty. Okay. And if you wanted to get even more crazy, the triple SRTY. Now this one only 740,000 shares. So, if you feel comfortable with that or not, it's up to you. I'm going to go back to TWM. Now, again, the question was, can you trade options on them? Yep, you can. Okay. Now, SPY is one of the biggest, most traded security really out there, right? As far as something that has actual value, right? 70 million shares traded of average volume on the SPY. But anyway, we're not talking SPY, we're talking IWM because it looks like it's starting to have a sell-off. So here we go. Let's go back to TWM. All right. Now broke through resistance yesterday. I'm going to zoom in a little bit closer. Broke through resistance yesterday. Where do we find a resistance level? Well, it's about right there, about $14, maybe 13 and a half, $14. And it had volume yesterday. Okay, so is that considered an entry point? Sure, meets our criteria. Uptrend, breaking through resistance. Is this an uptrend? Well, sure, it's broken through multiple levels of resistance, even though you might not see the visible higher highs and higher lows. But remember, I taught a class earlier a few months back about invisible, hidden highs and lows, right? So when it breaks through resistances and doesn't pull back, those are hidden highs and lows. So it looks pretty good. I'm comfortable with this. I'm going to go ahead and do a trade. So I'll click on the ask price. Now, again, I'm not buying 100 shares. I'll click 2 times on here. Now, since this is a stock, I'll just put in my $5,000 worth. I'm going to change this to market, go confirm and send. So we're buying $5,000 of TWM at the market to open. We're spending about $5,000 there. Looks good. I'm going to put in traded in intermediate advanced class, trading to the downside. 7, nope, not 7, holy cow, 8, 17, 23. Okay, I'm going to hit that and send that off. And we got triggered. This sounds kind of like a snowflake thing. I got triggered. There we go. I got triggered. Now we got it. We bought it. TWM right there. And if the IWM or the Russell continues to drop, this will go up. We bought 349 shares. Missed the one, the class on it. I don't remember exactly where it was, when it was. Let me do this really quick. Intermediate advance. I believe it was one of the first ones I taught back in April, maybe. Oh, right here, April 20th. Deeper dive into charting, finding the hidden support and resistance levels. April 20th of this year. All right. So, folks, I know we've gone over a lot of information. It almost turned this into a workshop, didn't we? Are you okay with that? Are you okay with this mini workshop? Oh, my goodness gracious. I'm sure you all need a break now. But we need to wrap this up. For those of you who haven't considered trading to the downside, do you feel a little bit more comfortable, at least being understanding some basics of what you can do to take advantage, so not just you're just handcuffed to only trading things that are bullish and going up and having to hang on to things that are going down? Okay, now they're somewhat, that's great. It's a beginning, but I wanted you to be exposed to some things that you can do. Now, some things will require certain types of an account, certain types of approvals from your broker. Some of them don't, like the inverse ETFs, but there's pros and cons to anything that you do in the market. I wanted to give you some ideas and some exposure to different things that you can do to take advantage of downward movements, so you can still have opportunities for your account to grow, or at least not lose as much from just hanging on to everything that's going down, and help weather those rough patches. And however you're going to do it, again, still get comfortable with your technical analysis. Your entries and your exits will not be thrown out the window. You will still make sure you have the signals that you need in order to do the specific trades. Okay, practice it though. So wrap up. Whoa, how did that one pop up first? Understanding the risk associated with the strategies. Trade to the downside with strategies you're comfortable with. And even if it's the inverse ETFs, that's great. Now, instead of doing it on an individual stock, you're doing it on a basket of stocks. Okay, those inverse ETFs, and the benefit of it still allows you to look at things in a bullish mindset, even though in reality, you're taking advantage of the underlying going down. Okay, and create a watch list with inverse ETFs if you wanted to. Practice trading in the paper trading account. That's what it's for, to help you get comfortable with that. If you want more information on the options, the classes, because we do talk a lot about option trading and downside with the puts and things like that. Certainly think about the option course and get that in the future. That would be fantastic. But folks, I appreciate you spending your time with me. I appreciate your fortitude of lasting this long. But if you do have any problems with the paper money platform, reach out to Thinkorswim. Or if you have questions, you can take them to the daily Q&A sessions. They may not answer option questions in the stock Q&A session. Just kind of keep that in mind. But if you have email, you can email us questions to the EDU support there. But thanks, folks. Appreciate you. I really do. Thank you so much for spending your Thursday morning with us here. Keep up the practice, keep up the good work, and keep up your enthusiasm for your education. And that's what I want to see from all of you there. So thanks. Have a great day. We'll talk to you in upcoming classes. Bye-bye now.